Welcome to EWA's FIN-LYT podcast. EWA is a fee-only RIA based out of Pittsburgh, Pennsylvania. We hope all listeners of this podcast will benefit as we deep dive into complex financial topics that we will make simplified for you. And we hope that this really serves as a catalyst so that you can make the best financial planning decisions for your family and also save time. In today's episode, we're going to talk about a new strategy called direct indexing. I think the best analogy I have for direct indexing is this is a technology that makes wealth management much more tax efficient. And the analogy I have is imagine a surgeon that now has the ability to operate with robotic arms. So the robotic arms are not replacing the surgeon. You still have a surgeon doing surgery on you, but the robotic arms allow them to be more precise and get to angles that the human hand could not otherwise. So direct indexing is simply a technology that does not replace the human touch. It really enhances the human touch. So a financial advisor like ourselves can do the best possible job for you. So we're going to talk first, what is it? And then Jamison's going to talk about what it's not. And then we're going to talk about benefits of it. And then we're going to close this podcast episode out with some direct applications for specific clientele that we work with, like physicians, executives, etc. So to get right into it, what is direct indexing? So if you think about a portfolio, like in your 401k, Roth IRA, typically you have a portfolio that holds funds. And those are either mutual funds or ETFs in generalities. And those mutual funds or ETFs generally hold hundreds of companies. And the purpose of those are to asset allocate, diversify. Jamison's going to get into that in a second because direct indexing is not replacing any of that. But specifically in a tax-deferred account like a 401k Roth IRA, it doesn't matter if you move between a Fidelity or a Vanguard fund. There's no tax consequences in a tax-deferred account. However, if you're a high-income earner, there are very strict limits on what you can put into a 401k. If you're under age 50 in 2023, the total, what's called a 401(c) limit is $66,000 a year. So that's obviously something smart to do. Roth IRA, if you're under 50, it's $6,500 a year. HSA, if you're married, filing jointly, it's a little bit over $7,000 a year. So there's these different buckets. If the government puts a limit on it, generally speaking, you should be maxing it out. But if you're, for example, making $500,000 to $1 million or $2 million a year, there's a lot of cash flow that you're going to need to save to keep up with your lifestyle later in life. And most of this money is going to end up going in what's called a non-qualified account. So just to be really clear, direct indexing, in our opinion, is a tax strategy that's not replacing any of our other investment principles, but it only works in a non-qualified account from a tax perspective. You could direct index in a 401k or Roth IRA, but to get the actual benefits of it, this has to be a non-qualified account, which is just after-tax money that goes in a brokerage account and then purchases things like stocks, ETFs, mutual funds, etc. So specifically what direct indexing is, now that we have that background, is if we look at each category, so our three rules of thumb for investing principles are asset allocation, which just simply means we want to take the lowest amount of risk to get the highest amount of return. So it's the marriage between high returns and low risk, which does limit the returns on the upside, but does limit the risk on the downside. It means you basically own 6 to 8 asset classes. And the second principle is diversification. So inside each asset class, you have to have at least 25 companies to remove 80% of a risk, of a company going down, and then 100 companies to remove 90% of that risk. So direct indexing is essentially you owning the companies directly that a fund would otherwise own for you. So if you own S&P 500 index, you own one fund, but really you own the 500 companies inside of that fund. If I'm a direct indexer, hypothetically, I would just directly go purchase those 500 companies myself. So that's just very high level what it is. We found that you need at least 100 to 150 companies to get within a 2% tracking error of, for example, if our large cap, if we want 40% of the portfolio to be in large cap, hypothetically, we would need at least 100 to 150 companies that are in the large cap category to get the tracking error within 2% return of what the S&P 500 would do. And the reason we've set this to 2% tracking error is because generally speaking, there's a 1 or 2% tax benefit per year to this. So worst case scenario, if you're on the low end of that return, you're still making it up from the tax benefits. And most years we found, you're still going to be ahead of the game with even or even better returns with being a direct indexer, although that is obviously not guaranteed. So Jamison, talk to us, because we've now, I think 95% of our clients that are high net worth clients or high income earners have adopted this model with their non-qualified account, done in 2022 in the market drop, which is amazing timing because tax loss harvesting is one of the purposes of direct indexing. But first, let's talk about what is it not. Let's be clear on what does it not accomplish.
Yeah, I think it's important to understand that it's not any different of an investment strategy. So like you said, we always follow whether we're investing in ETFs, mutual funds, stocks, bonds, main principles of asset allocation, diversification, long-term investing, asset location strategies. So this is not any type of, we're shooting for a really high rate of return. We're trying to say that, this stock's balance sheet looks really great. We're looking to outperform the indexes. We're actually trying to mirror the indexes exactly and get within a 2% tracking error, like you said, of that index. So shoot for the exact same almost returns. And in doing so, the main benefit is the tax efficiencies. And I think a lot of high net worth individuals, like you said, there's only so much money that can go into tax favored account. There's a reason the government limits how much you can put into. So they're always asking for new tax strategies of where they can put their money, save on taxes, because most of their income is getting hit, at the 37% tax bracket. So anything that they can save on is generally what they want to do. But I think you told me this quote the other day that Warren Buffett said that he has only picked like 7 good stocks or something in his lifetime. So it's like being able to pick a company is almost impossible anyway. So that, just to reiterate, that's not what we're trying to do. Try to mirror the index and the funds that we would already be invested in.
Yeah, this is not a stock picking strategy. We're trying to mirror the index. We're trying to invest with the market, not trying to time the market, not trying to beat the market. We're just trying to invest with the market. But instead of being a buy and hold ETF mutual fund, this is a buy and hold. We actually own the companies that otherwise ETF or mutual fund. So essentially, we're just removing another middleman, because then you remove completely the cost of the internal fees that a mutual fund or ETF would have that you're getting charged for on top of whatever your advisor is charging you for. So it's a much more cost-effective strategy as well. Okay, so let's talk about the benefits, and let's just go back and forth, because I know we've had hundreds of conversations in the last 12 months as we've rolled this out. I'm going to talk about, as far as benefits go, in 2021, we actually have this brochure that we'll put this in the show notes. It's a good, well thought out brochure the EWA team created. Put this right on our website. So, generally tax loss harvesting, if you have a brokerage account, this can be done with mutual funds or ETFs. So hypothetically, if you have a Fidelity fund in large cap that goes down, and you sell it, let's say you have 100,000, it goes down to 90,000, you sell it and buy not an identical, but a similar large cap fund, let's say a Vanguard fund, because you don't want to ever go out of the market another time. As the market recovers, you're in the same place, but that $10,000 loss in that example, you're able to now carry forward up to $3,000 per year actually against your income, and you're able to carry that forward forever until the loss carry forward is used. But you're also able to carry forward those losses to offset gains. So short-term or long-term losses, doesn't matter, offset short-term or long-term gains. And so if you think about when you retire, if you have a 401k and you're taking required minimum distributions out, you have Social Security, you're, whether you like it or not, whether your expenses are high or not, when you retire, you're going to show income between RMDs and your Social Security, maybe if depending on your age, if you have a pension or not. Then if you have a Roth IRA, that's tax-free. But typically, a high net worth person would have a large amount of their money in equities or private equity. When that stuff starts getting unwound, there are capital gains that have to be paid. And so if you're a direct indexer and you've done tax loss harvesting, diligently your whole life, all those losses, which are just subtle fund switches, and you can't go back into the original holding stock or fund within 30 days, and then there's also be a wash sale. You got to carry those forward with you for life and potentially offset all the gains you have when you're distributing. So it's an incredibly tax efficient way later to distribute your money. So that's one of the major benefits. And the reason the direct indexing really puts this on steroids is 2021. So this is in the brochure. The Russell 3000 index, which, U.S. stocks in general, so 3,000 companies, the index went up 25.7% that year. And so if you held the Russell 3000 fund, you put 100 grand in, it would have gone up, down a little bit, up, down. But there was really little opportunity to tax loss harvest because 2021 was a really good stock market year. However, let's say I was the fund holder. Let's say Jamison didn't hold the fund. He just went out and purchased the 3,000 companies directly, which would take a lot of time, a lot of effort. Out of those 3,000 companies, 992 of the 3,000 companies actually had a loss instead of a gain. So typically in an index, it's some of the companies do really well if it's a good year, but a lot of them are still at a loss. And so you would have had the opportunity to sell those 992 companies, buy replacements, get similar returns within a tracking error margin. But all those losses, if you didn't go back to the original state within 30 days, you would have in your back pocket for the rest of your life, whereas I would not. So just tremendously, in that example, maybe we got the same exact returns in 2021, within a tracking error of 2%, give or take. But Jamison now has an incredible tax advantage over what I would have had as just a regular fund investor. So that's really, in my opinion, the first benefit of direct indexing. But Jamison, give us some more thoughts.
A couple of things on the taxes. So first, just to fundamentally break that down, if you have 300, just overly simplify this, if you have 3,000 stocks in that index, you need 10% of it to be within a 2% tracking error. So let's say we need at least 300, hypothetically in this example, to get within that return. And so that gives so much flexibility of, okay, we have 300, but 900 of them were down. So just to make that overly simple, basically what we do is we take the same, think of say if you're, for example, investing in an Apple stock and tech's getting crushed and you sell Apple at a loss and you purchase something that ideally would perform very similar. Let's say you buy Amazon, and that's not a wash sale because it's a different stock, but they should, again, this is where the technology comes in and some of the math behind the scenes, should perform the same way, and then they'll rebound in the next 30 days, and you can either buy back to Apple or keep Amazon. So the first thing is just buying a similar performing equity and having that. We have a lot of leeway by only needing 10% to get within the 2% tracking error. And then
that gives you optionality when a company goes down. You have a replacement ready to go. Because typically, the amazing thing about the technology is if we did this by hand, it would take tons of reports, but the technology really just makes the human touch much more efficient because it gives us the data. And there is artwork here. So I wouldn't want a robot doing surgery on me. I want the surgeon controlling the robot because there are decisions that have to happen on the fly. So for example, if Apple drops and the technology is saying, hey, you can buy Amazon, but the tracking error is 3%, well, then we have the artwork to determine, is the tax benefit really worth that much when we're putting the integrity of the risk, we're allowing that to be higher than our philosophy, which is that 2% cap? And the answer is no. Whereas the technology would say trade, because it's just looking at the taxes. It's where we have to set those boundaries in artwork to make sure that the fundamentals of the investing strategy are kept in place, which are, again, asset allocation, diversification, and making sure you have a time frame, of at least 5 years for equity investing. So, no, that's a great point, Jamison. Give us some other examples of the benefits.
Yeah, I was going to say one other thing with taxes too. A lot of, just as we've really done this at a high scale over the last year implementing this, but a lot of high net worth individuals have, if you look at their tax returns, it's very complicated. They're probably not just a W-2 income earner. They may have, multiple K-1s, 1099 income, business ownership, whatever that is. And so if any of that, I'm thinking of one example of someone I work with had a private equity, it was a payout. It was a big gain, but we were working with a substantial non-qualified account that we had flipped into direct indexing in 2022. So the market was getting crushed. I think we realized 200,000 of losses. Didn't sacrifice the return of the portfolio because we sold out of the ETFs that he was in and then purchased the exact same companies in individual stocks. So the same return risk of the portfolio, but doing that, we were able to realize like 200,000 of losses, and that offset his private equity payout. So
and he's in the same, the portfolio's in the exact same spot it would have been if you had just let it sit there.
$50,000 in taxes.
The capital gains on the $200,000 gain. Yeah, that's huge. That's
so
a good example.
For high net worth people that have more, they're not everything's just taxed at an income rate like a W-2 employee. They're having, private equity, real estate, different things pay out. This is a great strategy to capitalize on.
Absolutely. So, other benefits are also just simple control. So if you have a company that you have strong affiliation to, let's say you held a certain stock for the last 50 years, and it just really it's more heart based that you want to keep it than or feeling based than logic based. And this happens all the time. The technology will work around that. So let's say you have $1 million portfolio and you have $100,000 in one stock, and we mark that as never trade this. The decision making, if you and I enter direct indexing at the same day, and I had the $100,000, I'd never want to sell it. The companies that would buy around that to get that tracking error down to 2% to mirror the indexes would be totally different. Not totally different, would be different than yours. So at the end, I get to keep my stock. I'd have a 2% tracking error. I'd be direct index, and so would you. But it provides a lot of flexibility for legacy holdings as well. And not just to say, oh, we're going to hold that in a separate account, let's forget about it. Well, that people don't know that your risk profile may be thrown out of whack. This takes all of that into consideration and allows the, again, what I call the artwork of the financial planning to really take place.
Yeah. And I think, like you said, there is a huge, you feel tied to a stock or psychology behind it, but a lot of executives at large corporations, a lot of their compensation is through equity payouts. So we've worked with some executives that, they're getting a bunch of stock options and RSUs, and maybe like politically it's in their best interest to sell the stock, but they may want to keep it for political reasons within the company, rightfully so. And so we're able to, get that concentrated position into the direct indexing portfolio and then do exactly what you just said, de-risk everything else around it, and that satisfies that asset class holding.
Absolutely. So I'm going to, there's this graph we have in this brochure that, if hypothetically, if you had $1 million portfolio and over 20 years, you got a, just normal returns after taxes of 6% versus if you were direct index and able to save 1% per year in taxes, have a 1% year higher return, that $1 million portfolio in the 7% return example, net of taxes, you'd have a $662,000 more than you would in the 6% return. That's what direct indexing does. There's actual academic research that shows, I think it's a little bit over 1%, 1.08% of actual value of alpha value add in your portfolio if you're a direct indexer versus not direct indexed.
Yeah, that study is super interesting. They looked at since 1930, I believe, I think it was the last 90 years, the S&P 500 performance versus if you just bought the S&P 500 index those 90 years, or if you owned the 500 companies in tax loss harvest. And that's what the study shows, is that a little over 1% benefit. So
incredible.
Yeah, very interesting. And I was going to say, along the lines of control, Matt, talk a little bit about, if you're in an ETF or mutual fund, you have zero control over the taxes they're kicking off to you on your...
Yeah, I mean, both, because if you think about like the S&P 500, so you share this statistic actually over lunch, Jamison. So the S&P 500, tell us like what was the average time frame a company stayed in the S&P 500 in the past and now, and what that's trending to now, because that's going to lead into helping me answer my question.
Yeah, this is really interesting. So if you look at just like lifespan of a corporation, it's about between 30 to 40 years. So a company lasts about 30 to 40 years. The S&P 500, if you look at, what is the S&P 500? The S&P 500 is an index of the 500 largest companies in the United States. And those companies move all the time. Whenever that report comes out by Standards & Poor, they could say, totally make this up, Google's out and Amazon's in, whatever that is. That lifespan of being in that S&P 500 index right now is 12 years. So the average company is in that top 500 for 12 years. It used to be in 1950, it was 7, which is even lower. But data is showing now that it's actually declining. So 12, I don't know what it was the year before, but it's trending backwards, back towards that 7 years.
There's so much polarizing differences in political beliefs. There's leadership differences,
and even
in technology, right?
20 years ago, I mean, think about like the biggest players. Well, think of this. Apple was like fundamentally the largest company in the world. Like they're the most
market
valued.
cap,
20. I don't say the 1990s. Like Apple was not the largest company in the world. Like nobody. Maybe some people would have predicted that, but it's the industry's changed, technology's changed. That it revolves all the time.
Okay, so thank you for that background. That's helped me now answer the question you had for me, which was, if you just hold an index, which is generally very tax efficient, when those companies change, the fund, you're paying a fee to a manager to make sure that you actually have the S&P 500, which isn't a change every year, which means the companies get sold out of it and companies get bought into it. And when you hold, even if you're not selling your fund, when there's turnover in a portfolio, the tax liability goes to you and every other person that holds the fund. And a mutual fund, that's like
huge,
the worst thing in the world if you're a non-qualified investor, because the turnover is crazy. Some funds have 10, 15% turnover, and maybe you even lost that year. Like you put 100,000 and it's worth less, but you actually have a tax liability because of that turnover. And direct indexing, there's taxes that help work for you, meaning there's losses that can carry forward, and there's tax that work against you, which means you didn't have a gain, but you're still paying taxes if you did. And so direct indexing not only gives you tax benefits on the upside, just as importantly, they avoid the tax liability you have the downside if you were a mutual fund or ETF holder.
Think of if you're a high net worth individual, and then another layer to that is like dividends get paid out. If you're holding an ETF or mutual fund and they're in a bunch of like dividend stocks, that's immediately everything's getting clipped at 37%. Whereas direct indexing, we can selectively, in the non-qualified account, maybe we're not going to hold companies that are high and paying high dividends. For that reason, we can be much more selective and have control over tax situation for your individual situation versus just a fund as a whole.
Yeah, and just to clarify, qualified dividends, which would be highest tax bracket 23.8, capital gains 23.8, and then non-qualified dividends or short-term loss would be the 37. But regardless, it is incredibly important to be as tax efficient. If you have a couple $1 million in a non-qualified account and you're direct indexing, and hypothetically you're able to limit your tax liability versus if you're on a mutual fund, a couple $1 million portfolio, your tax, your turnover, maybe a couple $100,000 a year, and if you're capping, paying a 23.8% tax on, let's say, $300,000, that's over $70,000 of tax you're paying on something you didn't even sell or you're not even using.
Yeah.
And that just is every year. That's $70,000 that's not, instead of getting reinvested, that's going to Uncle Sam. And that can be completely avoided by putting money in the right places, so prioritizing 401ks, Roth IRAs, HSAs, all the tax-deferred investments. But then after that, if you're a high net worth person, you're going to have to put the majority of your wealth in a non-qualified account, and being able to avoid that tax liability through tax loss harvesting, through a direct indexing strategy, is so essential to protecting your wealth. So last benefit we're going to talk about here, and there's a couple real quick hits, like donor advised funds, step up in basis at death. James, you talk about those in a second, but just from a cost perspective. So Michael Kitch is a well-renowned financial advisor expert. He has a blog, courses. So not only financial advisors subscribe to his stuff, but the general public does as well. Actually, a friend of myself and EWA's, great guy. He did a research on the average portfolio cost, not what you're paying to a financial advisor. So let's say in general it's 1%. It's a little bit higher than that for most financial advisors. The average portfolio cost on top of the advisor cost is 0.65%, which is just absurd. That's a lot of fees on a $1 million portfolio. That's $6,500 in fees. If you're a passive investor, you should be able to get that down to 15 to 30 basis points. So a half, or if not a third, of the standard, which is, in general, our philosophy: ride with the market, not against it. Active management most of the time will not beat just general index investing. The direct indexing eliminates that. You own the companies outright. There are no internal costs. So we layer in a small cost because the technology is expensive. We have to hire additional manpower. And more importantly, if you're a direct indexer, a big custodian like FIN-LYT, Charles Schwab, are two main ones that we use, they, for international trades, charge $4.95 a trade. It doesn't matter how big your account is. And so we sponsor a wrap program that covers all of those commissions. And so if you have buying 100 international stocks at $5 a trade, that's $500. And then if you have the tax loss to harvest that's another $500. So we cover all that. So we have this figured out where we're going to have the direct indexing cost is lower, more than half lower the average industry standard of a soft cost of a portfolio, and it's all inclusive. So we, commissions, all that kind of stuff. You try to do this on yourself. The technology, the tracking here, all of that stuff is included, which is really cool. So the cost reduction of a direct indexing is incredible.
And then so that 0.65, if you're in ETF or mutual fund portfolio, that never changes whether you have $1 million or $10 million in the account.
Not scalable.
And so talk about a little bit how we have it as the account goes down, that's going to slide down just like the advisory fee.
Yeah, absolutely. So the bigger your account is, it goes in half, it goes down in thirds. So I mean, it almost becomes, I think the lowest tier we have is like 10 basis points for that. So talk to us about just some couple quick hits on ancillary benefits, such as, step up in basis or donor advised funds, how direct indexing could benefit you more than just a regular investment.
Yeah, donor advised funds is a good one. There's a lot of tax savings and a lot of high net worth people that we work with. They're very mission driven. They're very they like to be philanthropic. They're working because they really care about some matter, something. That's what they're doing something for purpose. And so a lot of them are charitably inclined. And although we want to give to charity for the charitable reasons, if we're going to do it, we might as well be as tax efficient as possible. So a big benefit is if you donate into a donor advised fund, you take $100,000, you donate it, you get to deduct that against your taxes that year. So if you're in the highest tax bracket, save 37%, oversimplified example. If you donate an appreciated stock, however, some charities can accept an appreciated stock, some cannot. But if you donated an appreciated stock into the donor advised fund, so let's just say, again, oversimplified example, maybe there's a zero in this $100,000 example. Maybe the stock was gifted to you or something. There's a zero basis and there's $100,000 of gains. If you donate that, if you sell the stock and give it to the charity, you're paying capital gains taxes on it, so 23.8. And then you obviously get to deduct the donation. But if you donate the appreciated stock into the donor advised fund, you get to avoid the capital gains tax. So you're saving that 23.8, plus you're getting the deduction against your income for the charitable donation.
So $100,000 investment, you're getting over $60,000 immediately back in tax savings.
Yeah.
So being a direct indexer not only allows you to do that, the technology will also immediately adjust the integrity of the portfolio and say, okay, we're no longer holding. So let's say in that example, it was like a Tesla that you bought before it became Tesla, and you donated that $100,000 Tesla. Now the software is going to recommend buys and sells to get the tracking right back within 2%. If you were a mutual fund or ETF holder, you can't take that big of a sniper shot into a low basis holding. To not threaten the integrity of the portfolio, you're having probably to sell off a little bit of each fund to stay asset allocated, stay diversified. So the direct indexing, can't stress enough, provides the flexibility to be extremely tax efficient, which is amazing.
Absolutely.
So, okay, we're going to close this out and let's go into direct application. So the application number one, if you're in the highest tax bracket, which I don't know, married filing jointly is like over 600,000.
I think it's like 690 for 2023. It went up quite a bit. But
went up with inflation. And that means you're in the highest capital gain rate. So just talking about, Pennsylvania, we're talking about 23.8% plus a 3.07% Pennsylvania tax on any capital gains. Direct indexing, if we can avoid that, it's a protection of your wealth. You're keeping more money rather than paying it to taxes as your non-qualified accounts grow. In states like California, where state tax is even higher and higher, the tax benefits are even bigger. So Anyone that's a high income earner, anyone that's dollar cost averaging, we found this to be extremely effective. So if you're putting in 5 or 10,000 a month or quarterly, depending on how cash flow works, you're purchasing all these stocks throughout the year and dollar cost averaging high and low points, which is a safe entry point into the market versus being worried, am I investing too high, am I investing too low, et cetera. So my favorite application though, two favorite applications: asset location we can put on steroids through direct indexing. So what asset location is basically, essentially, if you have a football team and you have a quarterback, you don't want your quarterback on the defensive line. You want him as a quarterback, right? So a lot of investment portfolios, we see these mistakes. You don't want to put a high turnover real estate investment trust into a taxable account where you're paying all kinds of taxable events, or a high turnover mutual fund. In emerging markets, generally speaking, are higher turnover. But if you stick those kind of holdings inside of a Roth, inside of a 401k, it doesn't matter. That's all tax deferred. You can really stick your blue chip companies, individual companies, a direct indexing model, and you can oversee all of this together. So instead of viewing each account as a football team, your entire portfolio, your 401k, Roth, HSA, taxable account, everything's one account. And we're sticking the investments to mitigate risk and get the corresponding highest returns possible for the lowest amount of risk. The asset allocation, we're doing that the most tax efficient manner, on top of the individual benefits of direct indexing and how tax efficient that is. So that's that's the application. My favorite application is the asset location aspect of this. My second one is for executives, or for any person that has a RSUs or company stock. And so a lot of times what we find is, if you work at a tech company, if you're an executive, generally speaking, we've seen up to about half of your compensation on a yearly basis is going to be through stock. And so as an actual example, let's say someone has a salary of, $300,000 and then has a cash bonus, but then they get given $300,000 of restricted stock. And then those get taxed when they vest. So 3 years later, typically those get taxed. And a lot of clients that come to us after doing this for 10 years, their balance sheet is like 80% company stocks. And not only is the company that's paying them their paycheck a risk, because they have such a high lifestyle and such a high cash flow based upon one company, their entire balance sheet, almost their entire balance sheet, is also predicated on the success of this one company. So politically, a lot of times executives will need to keep 1 or 2 times their salary in the company stock. So if we have a couple $1 million in the company stock, and we want to first recommend to start diversifying that, we can move all of that into a direct index portfolio, sell some of it, keep some of it. So then the decision making and process of what companies are built around that are all predicated on that staying forever. And that is a risk management technique that I cannot speak highly of, because there are some companies, Jamison, you can speak to one of your clients. The stock was literally at over $300 a share, and we recommended to sell it. And that client was like, the CEO says it's going to 500. Well, sitting today, this is 2 years later, the stock's at under $10 a share. And so it was millions of dollars of savings in that example. That one, luckily, it wasn't there was no requirement for this client to hold the 1 or 2 times salary. So luckily it was all sold, but it literally saved millions of dollars.
Yeah.
But you looked like you had something to say while I was talking about, so I'm going to hand it over to you.
With the asset allocation, I'd say one other application is clients in distribution phase. So if you're a lot of advisors, and just speaking from like previous firm we were at, a lot of advisors, depending on your platform, there may be in like a model portfolio. And so if you're selling, let's say you're retired or you're taking some sort of distribution, they may have to sell across every asset class. So they may be properly asset allocated with an ETF or mutual fund within each asset class. But if they want to send you money back, they have to sell a little bit of each category, essentially. And that could be good if the market's up, but if the market's not doing well, you may be choosing to sell losers versus only selectively selling the winners. Direct indexing takes that another layer deeper. So we could, not only would we have all the asset classes covered, let's say within large cap, for example, maybe large cap's performing as a whole asset class down, but maybe tech's doing really well. So within the large cap asset class, tech stocks are still positive, and we can take that sniper shot of, okay, let's sell these tech stocks in a year that the market is down 20% at a gain to eliminate locking in any losses, which will obviously be, a huge benefit to the portfolio long term. So if you're in distribution or taking any type of withdrawals from the portfolio, this can eliminate a lot of risk to that as well.
Yeah, and I think the nice thing about high net worth financial freedom is there really is no time frame. I mean, it's literally there's going to be enough for you to live off. There's going to be enough for your kids. So the time frame is very, very long. Yeah. And so having an approach where you never accept losses and only take out at a gain provides a lot of just not only flexibility, but the probabilities for success go up tremendously.
And just because we talked about selling losses a lot, if we are selling losses, we're buying back into the market. This would be
immediately
sell a gain to take actual cash out would be the difference. So.
Yeah, you're selling one stock, you're buying something similar to keep that tracking error immediately, same day. So, well, thanks for tuning in to our podcast. Hopefully you found this helpful. If you found it helpful, we really hope this is as beneficial and impactful to as many people across the nation as possible. So hit the follow button. Make sure to rate the podcast, and please share with any friends or family members that would also find this beneficial. Thank you very much.